This video is going to be divided into three parts. First part is why you should save money in the first place. Many of you might know why you need to start saving money at a young age, but I will still discuss on it further. Second part of the video is going to be advice that I have personally learned from reading many books, watching many finance YouTube videos, and from my degree of business. Third part of the video is going to be a list of questions I've prepared for you to ask yourself whether or not you're doing everything right and whether or not you should be saving money. So without any delay, let's jump right into the video. Now, many of you know why you need to save money. First is inflation, and second is you need to start at a young age for the multiplying factor. Now, what the fuck is multiplying factor? We all know that due to compounding, the longer you keep your money invested, the more it will grow. In short, compounding allows your money to grow at a higher rate because you not only get interest on the principal amount that you invested, but also the interest on interest. Let me explain. For example, if in the first year you invested 100 rupees and got 5 rupees back, the second year you will get interest on the 100 rupees as well as the 5 rupees. So you get interest on the interest of the amount that you put to invest. So yeah, your returns depend on two things. First is the total amount of the investment as well as the duration of the time period that you keep your investment in the market. But since at a young age you do not really have a proper source of income, a lot of people say that focus on yourself and build your skills. To them I say that's good advice. You should invest in yourself and build skills, but I think learning how to invest your money is also a very important skill. For example, if at the start of my investment journey I am only able to save 1,000 per month, that is obviously nothing compared to what I could be saving, like 50,000 when I do in the future have a very steady source of income. But the thing is, when you start to get the steady source of income and you have 50,000 to invest in the stock market, you do not at that point understand or know when or where you should be investing. This is important because when you have 50,000, that's a lot of money and you do not want to be risky with that. But when you have a small amount, like you're saving 1,000 every month or even 500 every month, that's totally upon you. But the point is, save something, because that's the time to be taking risks, when you're only able to save a little amount. Because later on, when you're saving 50,000 per month or 1 lakh per month or 5 lakhs per month, you do not want to be gambling with that money. So you better start very early in your investments so you learn, because this financial independence and financial management is the most important skill you'll learn in your lifetime. Okay, so here's a trick I've used multiple times in my teenage years to save money. If I'm going to order from a restaurant outside, I ask myself if I really want that burger. Of course, this is easier said than done, because in the moment you want the simple pleasures. But the thing is, if you think about it, should I not invest this 300 rupees in an investment where I could turn that 300 into 600 or 900 or 3,000, if you think like that, you can start saving up money and take from the things that you don't really need and put it in your investment portfolio. But the problem is, if you do want to save that 300, maybe you're not able to. For example, a stock like Bajaj Finance at the time of recording is at 7,000 rupees. And if you want to buy that stock, you're going to have to save up for that stock. And even for someone like me who is not really earning that much, where even in 1 month I can invest 7,000 in the stock market, buying one stock becomes very difficult, which is where mutual funds and index funds come into the picture. So mutual funds and index funds allow you to save whatever denomination you want in the stock market. So for example, if you want to save 100 rupees, you can put it in Nifty 50 and you don't have to collect basically 7,000 to start investing. Obviously, different mutual funds have different minimum amount. You'll have to research that before you invest in whatever you want to. Learning how to invest is a very difficult journey. How do you begin? First, you need to install a very good trading app. Then you need to get your KYC done, and then again you have to wait for 2 or 3 days before you are allowed to invest so that you get verified. I'm like, why? Just let me invest. I want to give you money. But yeah, even when you can invest, you then have to think about a good investment. Should you go in stocks? Should you go in bonds, gold, real estate? There is so much things you can invest. Definitely not future and options. I do not recommend future and options, but apart from that, there is a lot of things you can save in. So based on what type of investor you are, you choose what type of investment instrument you want to invest in. I just said invest a couple of times. For example, if you want to invest in stocks but you don't know what type of stocks to invest in, you can give your money to a mutual fund manager. They will obviously take some commissions, but on your behalf they will invest in type of stocks of your choosing. There are different mutual funds out there with your risk tolerance. If you want high yield, high risk, high return types of investments, then there are mutual fund for those. If you want low risk, there are mutual fund for them as well. Before my audio and video stopped cooperating with me, I was talking about mutual funds and how it is not for everyone. But if you're like me and you do not want to give your money to a mutual fund manager, then what could you do? So there are these things called index funds. There are different types of index funds. Some are industry specific, some are sector specific, but some are like Nifty that diversifies your portfolio across all sectors. So you get exposure in a wide range of stocks. But why is diversification important? Diversification is important because you can spread your investment and your stock across industries. Now, why is that important? Imagine you have all your stocks in the defense sector, or let's take something common, tech sectors. You have invested in TCS and several companies like Infosys. But what if tomorrow there is a huge correction in the tech stocks? So all of your wealth will be wiped out. Now, I'm not trying to scare you, and you can't be scared away. If you want to grow your money, you have to start to learn how to invest. This is another reason why you should start early, because if you're going to make mistakes like these, it's better you make them early, because when you have to play with your entire life savings, you're not going to gamble. Now, a lot of you might tell me, my uncle XYZ lost all of his money in the stock market, and that's why my parents also do not allow me to invest in the stock market, and I am very scared for the money to get wiped out. Now, let me talk about how do you actually lose money in the stock market. The only way to lose money in the stock market is by selling your stock lower than what you bought it for, which is why I tell you to be invested in the stock market for a very long time, because the risk of you losing money over a period of time is lower compared to if you trade every day. If you buy now and sell tomorrow or day after, that's very risky. Because in short term, the value of the stock is going to go up and down, but in the long term, it's always going to go up. That's why if you look at the chart of Nifty 50, over a period of time, it has always gone up, even though there were some corrections like the 2008 housing market crisis, as well as the COVID-19. If something like COVID-19 also cannot completely destroy the stock market, then nothing really can. So there is obviously a risk that if I make this video today and you start investing today, tomorrow something might happen big in the Indian economy and all of your money might lose by 20%. But the thing is, for anyone who is smart enough should not get panicked and sell his holdings, because over a period of time it is always going to grow. So the only way to lose your money is by either not diversifying enough, only putting your money in one stock. That stock can go to zero, and also maybe just trading on a daily basis. Think about it, Nifty 50 hitting zero. If you're buying 50 companies, the probability of all those companies going to zero is basically like there's a zombie apocalypse in the country, and by that time you should not worry about money. Hide and find a bat with spikes or something. So as I talked about, there are only two ways of you losing your money, and one is not diversifying, and the other is not keeping your money in the stock market for long enough. But what if you need to withdraw for some expense that you did not see coming? That's why I recommend building an emergency fund. See, if markets are all going down and they are 20% corrected, that's the worst time to sell your stocks. And if that's the time you want your money, you better have an emergency fund so that you don't have to sell your stocks when they're at an all-time low. Your emergency fund should be able to sustain you for at least 3 or 4 months if you have lost your job. So of course you should not sell when the market is down, but what about when the market is up? You should sell, or maybe even throw a party with your friends, right? No. Which brings me to the next point. Never withdraw your money from stock market, even if the markets are an all-time high. Yes, you can choose to move your money around in the market. If you have an overvalued asset, you can choose to buy an asset that might grow more than your other asset. You can obviously sell those assets that are not performing well as well. But never take the money out from your investment and fund your expenses, day-to-day expenses. The reason being, I've already taught you about compounding. So let's say in 3 or 4 years, or even 5 years, your money doubles. It is going to double yet again in another 3, 4, 5 years, or whatever, 10 years, right? But that doubled amount is obviously going to be less if you have withdrawn from your investments, which is why build an emergency fund. If you really do need to take out from your investments, don't take out from your investment, take out from the emergency fund. For me, I've never given myself the option to withdraw from my investment, which is why I think you need to create a budget. because if you go over your budget, that is when you're probably going to withdraw from your investment, because that's what savings are for. But the thing is, you should never go over your budget, and if you do, just withdraw from your emergency fund, and when you have more money, rebuild your emergency fund. Instead, do not touch your investments. One psychological trick that had helped me was I observed how I saved money for when I was saving for a shoe or a new gadget, and whatever tricks that I used to save up money and pool my money for those things, I could use those same tricks to invest in the stock market. But at the end of the day, which brings me to the last point of the video, is your investments are not going to grow as much if your principal amount, the amount that you've invested in the market, is not much, which means increase your income, and you have to learn skills that will help you increase your income. Even if you save every month and never take out from your investment and still have a diversified portfolio, you will not be able to increase your investments until and unless you have a active way of increasing your salary every couple of years. So guys, the video has pretty much ended, and I'm going to make videos on a wide range of topics, not just on finance. The things is that I'm experimenting with this channel. I want to make content that will help everyone. So if you like this video, be sure to subscribe. I would like your feedback in the comments or even ideas on what topics I could make videos on. But yeah, I'll see you guys in the next video.